All right, let's talk about Intel. It's a name everybody knows, but here's the thing. Almost everyone is looking at the company all wrong. They see one giant corporation, but that's a huge mistake. In this explainer, we're going to give you the correct mental model, the two-company framework that truly unlocks what's going on. Let's get into it. So here's how we're going to break it all down. First, we'll tackle Intel's core two-company problem. Then we'll look at how its legendary business model completely broke. After that, we'll dive into the shocking financial divide between its two sides, figure out the right way to value them, understand the massive all-or-nothing bet on its 18A tech, and finally, we'll deliver the final verdict. Okay, first up, Intel's two-company problem. And honestly, this is the only way to make sense of the stock right now. The single most important thing you need to get your head around is this. Intel is not one company. It's two totally different businesses living under one roof. And once you see that, everything else just clicks into place.
So on one side, you have the products company. This is the Intel everyone knows, right? They design and sell the CPUs for your laptop and for giant data centers. This part of the business is a cash cow. It's established and super profitable. But then on the other side, you have the Foundry company. Think of this as the factory floor. They're the ones spending billions to actually build the physical chips. This is strategically crucial, for sure, but right now it is losing an absolutely staggering amount of money.
So if you boil it all down to one single idea, this is it. The profitable products business is paying the bills for this entire turnaround. But it's the Foundry business that drives the whole argument. It's what everyone is betting on, for or against. The ultimate question for the stock is pretty simple. Can they turn this giant, expensive manufacturing bet into actual, real-world profits? So you gotta ask, how did a powerhouse like Intel even get here? I mean, they were unbeatable. To understand this dramatic new strategy, we have to go back and see how their old golden model completely fell apart.
For decades, Intel's model was, well, perfect. They designed the world's best chips, they built them in the world's most advanced factories, and they just dominated the market. It was a beautiful, virtuous cycle. But then the 2010s happened, and to put it bluntly, they just fumbled. Intel stumbled, fell behind, and lost its manufacturing crown to rivals like TSMC. This forced them into a radical response, the IDM 2.0 strategy. It's a massive plan to double down on manufacturing and, this is the key, open up its factories to other companies. And just like that, you have the two Intels we're talking about today, now led by CEO Lip-Bu Tan.
Now, let's get into the financials, because this is where the story gets really, really wild. When you look at the numbers, you see a divide between the two Intels that is just shocking. First up, the products division. In fiscal year 2025, the part of the business that sells all those CPUs for clients and data centers made a massive $12.7 billion in operating income. I mean, that is a mountain of cash. This is the engine of the company, and it's still incredibly profitable. But here's the flip side. In that exact same year, the Intel Foundry division lost a staggering $10.3 billion. Let that sink in. It's a $10 billion hole. That's the cost of this turnaround, and it's an enormous anchor that the products business has to tow. And this table just lays it all out, plain as day. You can see the client computing and data center groups. Together, they're raking in over $12 billion in profit. But then you look down at the Foundry line, and that $10 billion loss just wipes almost all of it out. It's a perfect picture of one part of the company totally subsidizing the other. So this leads to the big question that messes everyone up. How can a company with a division making almost $13 billion in profit end up reporting a total loss of over $2 billion? It doesn't sound right. But it makes perfect sense if and only if you use our two-company model. The Foundry losses are just so massive, they pull the whole company's bottom line into the red. Okay, so with a financial picture this split, it's pretty obvious that the old ways of valuing Intel just don't work anymore. You can't use them. We need a much smarter framework, one that treats these two businesses separately. And here it is, the biggest mistake most analysts and investors make. They look at Intel's messy, consolidated earnings number and just slap a standard P/E ratio on it. It's completely misleading. As we just saw, that number is a meaningless blend of a huge profit and a huge loss. It tells you absolutely nothing useful. So, the right way to do it is with a sum of the parts framework. Here's how it works. First, you value the products business as if it were a fabless company, one that just designs chips.
Second, you value the Foundry business all by itself, and you probably have to put a pretty big discount on it because of the losses. And then finally, you just add in the cash, subtract the debt, and account for any other pieces. It's the only way to get a truly accurate picture. Okay, so we've covered the two companies and how to value them. But the success of this entire turnaround, all these billions of dollars, it really boils down to one thing: a massive, high-stakes bet on a single new technology. This is the whole ballgame. And that bet is called Intel 18A. This is their next-gen, most advanced manufacturing process, and its success is the absolute linchpin for the whole strategy. This isn't just another small step forward. It's the giant leap they need to make their own products competitive again, and, just as important, to convince anyone else in the world to trust their factories. And this slide really puts the stakes in black and white. It's a make or break moment. If 18A succeeds, everything starts looking up. Their own products get better, the Foundry suddenly becomes credible, and the whole valuation of the company gets stronger. But if it fails, the whole turnaround plan is in deep, deep trouble. Products fall even further behind, and their Foundry dreams are basically toast. All right, let's pull all these threads together. We've gone through the two-company model, the wild financials, and the high-stakes 18A bet. So now it's time to put it all together into a final verdict on Intel. At the end of the day, the argument really boils down to this. The bull case is that the products business gets its magic back, the Foundry actually becomes a real, viable alternative for chip designers, and the market finally starts treating it like a valuable asset. The bear case? Products keep struggling, those giant Foundry losses just never stop, and the sheer amount of money they have to spend just overwhelms any chance of making a decent return. And you've got to be realistic about the risks here, because they are very real. The biggest one? The Foundry might just never make enough money. The amount of capital they're spending is just eye-watering. Plus, Intel has to prove they can actually execute after years of missteps. Meanwhile, their products business is in a dogfight. And finally, to pay for all this, they might have to issue more stock, which waters down the value for current owners. So we'll leave you with this final thought, because it perfectly captures the whole story. Think of Intel as a high-risk, high-reward turnaround. The profitable products business provides a safety net, a floor that keeps the stock from totally collapsing. But the real story, the massive upside or the crushing downside, it all comes down to the Foundry. And the ultimate question for any investor is whether Intel's undeniable strategic importance can finally be turned into actual acceptable profits.